quickly recapping, I'll show you the strategy that I follow in terms of momentum investing. This is one of the simplest styles of investing that I follow. So first, I'll select the universe for any momentum investment, or even for that matter, any style of investment. We first need to identify from where should we pick our stocks. So that becomes our universe. So I'll never pick stock which are beyond this universe. Within this 200, one of the stocks will always lie, which I'm going to pick. Now, the reason for choosing a universe is because I wanted to pick stocks which are more on the conservative side and which do not have erratic reactions. But if someone who's more aggressive, they can definitely take exposure to mid cap, small cap, and even further micro cap. So that is on style. Now, once I have the universe, what I do is I do some filtration. Now, these filtrations, I'll talk about them one by one, and I'll explain what is the logic behind choosing this filter. The first filter is I'll see if the closing price of any stock is above 100-day EMA. And secondly, I'll also see that the 100-day EMA is above 200-day EMA. EMA is exponential moving average. The reason I choose these two metrics or these two filters is because I want to see the stocks which are in an uptrend or which are having absolute momentum. Basically, absolute momentum means the stocks are performing better than its historical prices. Now, what is a better metric to judge historical price? It is nothing but its own moving average. So stocks which are performing better in absolute momentum terms will outperform in any market. So that is based on a research done by previous academicians. So the second metric that I take is, or the third metric that I take is the 1 year return should be greater than 6.5%. Now, 6.5% is the FD returns that we get if you deploy your money or park your money in any fixed deposits in banks. So these three, the close price above 100-day EMA, 100-day EMA above 200-day EMA, and 1 year returns of the stock price should be greater than 6.5. All these three combined are nothing but checking whether the stock is in absolute momentum or not. Absolute momentum is the stock in itself should be in an uptrend. The second metric or the second filter that I do is the number of up days in the last 6 months should be greater than 50%. So the last 6 months I'll take and I'll see how many days are there where there is a positive closing or a green candle. And I'll also do a counting like how many days were there where there was a negative closing or red candle. If the number of green candles in the last 6 months is greater than the number of red candles, then it means that more number of days were there where the stock tried to rally up. The reason is it helps in picking those stocks which are moving smoothly. So this was done in a research paper called as Frog in the Pan, Continuous Information and Momentum. Now, what does this research paper say? This research paper says that a series of frequent gradual changes attracts less attention than infrequent dramatic changes. And hence, the hypothesis, they find that continuous information induces strong persistent return calculation that does not reverse in the long run. So this essentially says that if you are picking a stock which is moving up gradually, if it is moving up gradually, then there is a less attraction or less attention from investors to these stocks. Now, when there is less attention to these stocks, then what happens is that the stock slowly climbs up without having a lot of drastic moves. Whereas if you find a stock which is moving sideways or consolidating in a normal range and suddenly jumps up by 10%, 15%, and again it falls back or it stays calm, and then in one or two sessions it again jumps by 20, 30%. These are the stocks which get a lot of attention, and the moves in such stocks are erratic, and the momentum generally does not long last. So hence the conclusion that this research paper says was that a strategy that focuses on the path dependency of momentum generates a much stronger momentum effect. So they figured out that momentum lies not only in the absolute returns, but also in the path a stock takes. If a stock takes a more smoother path, then it has a dependency or a tendency to generate a much stronger momentum effect. Now, for that reason, I've included this filter of number of updates in the last 6 months to be more than 50%. So whatever filter that I take is based on an academic research. I wanted to try that this academic research is used as a practitioner in investment. Now, the third or another important filter that I take is the stocks must be within 20% from its 52-week high. So what is a 52-week high? If you see any chart, let's say, let me show you an example of a stock. Let's take the example of HAL. So if you see the stock HAL, this black colored line is a 52-week high, meaning in the last 52 weeks or 1 year, we plot the line or the price point where it had reached the maximum, somewhere around these levels. Now, if the stock is closer to its 52-week high, it has a tendency to move even further up. So a stock which is making new highs has a tendency to go even higher. Again, this is not based on any random trading wisdom, but it is actually backed by a scientific academic research. So I'm going to show you two research papers done on this part. The first one was done in the international or the US market, where they have figured out that the 52-week high, and they've compared that with the momentum investing. So they found that the 52-week high stocks perform better, in fact, than the momentum stocks. So the same research was done even in India also, very recently, in the year 2023, by the title 52-week high effect and momentum investing. Evidence from India. This was done by Rajan Raju. I'm going to show you the main summary. If you want to go in depth, I'll share these links or research papers with you. You can find that. So the main summary that they have figured out is that our findings are statistically significant and valid across various weighting schemes, reaffirming that 52-week high effect is a distinct and robust market anomaly, offering a more stable alpha than academic momentum in Indian equity markets. Furthermore, we find that 52-week high strategies have weaker long-term reversals relative to academic momentum. So they have figured out that not only that the 52-week high stocks beat momentum stocks, but also they have a tendency to last even longer. Now, if you combine the academic wisdom or the academic research of figuring out 52-week high stocks and combine it with the momentum stocks, then we have an even higher probability of picking great stocks. So how do we define a 52-week high? So the way to define a 52-week high stock is you need not necessarily pick a stock which is exactly on the 52-week high. You can take a range. Maybe let's say from the 52-week high, you would want to pick stocks which are in the top 15% from its 52-week high, or maybe 20% or 25%. So what I chose was a 20% as a metric. Like if there's any stock which is less than 20% from its 52-week high, then I'm interested in those stocks. And I'm interested in those stocks if they are also in the momentum screener. Now, these are the precursors of all my filtrations. Now, once I filter these stocks, that stock should be in uptrend, stock should have absolute momentum, stock should be undergoing a smooth pattern, and stocks should be within the 20% or at the 52-week highs. Once I filter that, then I get stocks which are in uptrend. Now, from this filter, then what I'll do is I'll sort the stocks based on their momentum. Now, how do I get momentum? I take last 1 month, last 3 month, and last 6 month momentum. And combining these returns of 1, 3, and 6, I'll calculate individually last 1 month rank, last 3 month rank, last 6 month rank. So I get 3 ranks. Now, what I'll do is I'll calculate a final rank, which is nothing but the sum of all these 3 individual ranks. That's how I get the final rank of all the stocks which are in momentum. I'll sort these stocks with the stock having the least rank as the top and the stock having the biggest rank as the bottom. Now, that was the complete logic or breakdown of what is happening. Now, once you have understood what's the backstory of the logic, let's go over the code one by one and just see what I've tried to implement here. So basically, we install a couple of libraries. Then we need Yahoo Finance to fetch the data for the tickers from a start date and an end date. And then we'll require pandas and numpy to perform certain numerical operations. And we'll need datetime for getting the delta of, let's say, 1 month, 3 months, 6 months, and also calculating the moving averages. We need the difference of the delta. And we'll need matplotlib basically to plot the final table of the stocks that I want to choose. So once we've imported, then we'll need to put down the list of tickers that I need. Now these are the 200 in Nifty 200 or NSE 200 tickers that I have. So a better way, let's say if you want to have Nifty 500 stocks, then you can just go to NSE and you can download the list of Nifty 500 stocks. Now this list of Nifty 500 stocks, you will need to convert it into a comma separated so that it becomes like a list. So maybe simply you can do a concatenate function. You can simply do equal to this is the symbol that you need to take, and you need to insert .ns because we'll have to read these stocks from Yahoo Finance. So this way you get the stocks in a format which is compatible with the Yahoo Finance. So you can use the comma separated here just in case that you are making a list of the stocks. Okay, so that's how I prepare the stock list and use it in my tickers table. Now in Google Colab, the best thing is that so whatever we are doing, we don't have to again use some other tools to run this. We can use in the same tool to run this. Now, once we have all the list of stocks that we're going to do this screener, the next step that I'm going to do is to fetch the historical data. For me, if you've noticed, I only need data till last 1 year because for momentum, I'll need last 1 month, 3 months, 6 months, and I also need exponential moving average of 100 days and 200 days. So I don't need any data more than 200 days. So for that, I'll write a function which basically gets the data of a given ticker from a start date till an end date. Now this start date and end date will also define. The start date and end date are defined as the end date is always today, because if you're running this screener today, you'll need to get the data from as on today, live data. So the what I'll use is end date is equal to date time to today. So this will always get the real time data. If at all you're running this screener, I suggest to run in the evenings around 5:30 or 6, so that we'll take into consideration the entire trading day and you'll get latest data. The start date is taken as end date minus time delta days equal to 365 into 2. I've just taken it as a precaution. Maybe let's say sometime if I want to use not just 3, 6, 12 months, 1, 3, 6 months, maybe I want to use 3, 6, 12 or 6, 9, 12, or maybe even longer time frames. So just as a backup, I've taken last 2 years of data. So some of you guys might also be thinking like, why am I taking only 136? Why can't I take other date ranges? It is completely possible. It is on personal discretion. If you're okay with taking a longer time frame, that is also good. Even if you're taking a shorter time frame, that's also good. Each has its own merit. If you take time period which is too short, like 136, then there will be a lot of fluctuations or variations because the recent price changes will undergo a lot of volatility. But if you take a longer price range, then they are more or less stable returns. But the problem is if you take a longer price range like 12 months or 9 months, then any stocks which are recently starting to go up, they'll never come into your screener unless some considerable amount of time has been passed. So that's the reason I take a mix of short duration, that is 1 month, and also take a considerable long duration, 6 months, and medium term, 3 months. So you can also play around with different time periods and construct your own portfolio. Now, once we have set the dates from where we want to pick the ticker dates and prices stocks, right? The next thing is we'll need to create a dictionary to hold the stock data that we're going to get. So basically, once we do the filtration from these 200 stocks, we'll be left over with some small number of stocks, maybe around 100, 120. Now these 120 stocks will be stored separately. Now, after that, what we'll do is for every ticker that is there in this list, what I'll do is I'll ensure that there is sufficient data, because what happens is, if you see that what I'll do is for ticker and tickers, try stock data equal to get data ticker comma start date comma end date. That is, I'm calling this function. This function nothing but it uses Yahoo Finance to fetch the data for a given ticker for a given start date and end date. And if the length of stock underscore data is greater than 0, then throw or give the data and put it in the dictionary data ticker equal to stock data. If there is no data, if there's even not even one record, then throw an exception that there was error fetching so and so ticker. Now this is critical because sometimes the ticker name changes or the stock name changes. For example, there was Larsen and Turbo Infotech, LNT Infotech. Its name got changed to LTIM because it acquired Mindtree. And then there was McDowell. Its name got changed to United Spirits. So a lot of times the ticker's name changes, or sometimes some of the stocks or tickers get delisted, and some new stocks come into the universe. So it is important that which stocks are getting exited with what is happening. So that is the reason I always keep this error in check to see if there are any stocks which are missing out. Usually, the Nifty 200 rebalance happens twice a year. That is at the end of March and again at the end of September. So you can keep this in mind. March and September end are the dates where some changes will happen to our Nifty 200 index. Between these two dates also, whenever there is any delisting or mergers, acquisition, the stock tickers can get changed. So keep a track of it for your respective index. If you're using Nifty 500, then please track when are the rebalances happening for Nifty 500. If you're having a mix of universe, like you're not following a market cap universe, you are having your own set of stocks, some from Nifty 50, some from Nifty 100, some from small cap, micro cap, then you should always keep a track of all these stocks, whether they're still there or not. So this step or this piece of code helps me check if there's any error in any of the ticker. Now I see that when I run this code, you also see that all the tickers are available and the data has been fetched. Now for whatever stocks the data is fetched, now next thing that we'll do is we will analyze each stock in terms of filtration. Now to create that, I'll create a summary data frame. Now in this data frame, the first thing that I'll do is for the ticker and df in data.items, data.items, basically in this from this dictionary. For each stock, I'll calculate a new column called as EMA 100. Now the EMA 100 is based on the close price. For the close price, we take exponential weighted moving average. The span we give is 100, and we take the mean. If you want to tweak, if let's say you want to remove the 100 day, you're only bothered about 200 day, you can put a comment and remove this altogether. Or if you want to change it to include as a 50-day EMA, you can change these values to put 50 and you can calculate. So these are some of the changes that you can tweak. The next thing that I'll do is I'll also calculate and keep a new column called as EMA 200 for all the tickers that we have in this list. Now the data frame now contains the tickers as one column, the start date, the end date. It also has other data points like open, high, close, adjusted close, volume, etc. Apart from that, we're adding two more new columns, EMA 100, EMA 200. Then the next thing that we do is we'll calculate what we call as 1 year return, which is nothing but DF close minus 1. DF close minus 1 basically tells us that this is the recent most record. Divided by the DF close minus 252. This is the 252nd row from the bottom. The reason for taking 252 is roughly we have 250 trading days in 1 year. So instead of taking the exact 365 as a number, if I take 365, then what will happen is it will take 365 trading days back data. So it is more than the calendar year. So to take exact 1 year calendar year, I'll take minus 252. So the current price divided by the 252nd backs dates close price minus 1 into 100, that will give me a 1 year return. The next thing that I do is I'll take the 52-week high. Now the 52-week high is calculated as from DF in the data frame for the column close for the range from minus 252 till now dot max. So what this function does is it calculates for the last 252 days of the closing price, whichever is the max value. So if you see in this figure, what we essentially need is from the current date till the 252nd date, we'll need the max closing price. The max closing price is somewhere like this. So that's what this function will return. And this function, once it it returns back and it stores in high underscore 52-week high. Then what we do next, we see that the DF close minus 1, meaning the recent day's price, if it is greater than or equal to high underscore 52 underscore week into 0.8. So we have calculated the 52-week high value, and we see that if the current days, the closing days price is greater than or equal to 0.8 of high 52-week value. So essentially what we're doing is we are just checking, we've got the 52-week high value here, and we are seeing that, if you're unable to see, I'll just zoom in. What we're doing is that we've got, let's say, this as the 52-week high value, this one, and we are comparing it with the recent close. And we are seeing if this value is greater than or equal to 20% of 0.80% of this value. Let's say this value, the 80% of the 52-week high will be somewhere around the 20% value, like this. So 80% of the 52-week high is somewhere around here at these levels. Now the check that we're doing is if the close price is greater than or equal to this value. If this is met, then we say it is in the 52-week high range. Then our condition is met. So this is one filtration that we do. So let me go back to the code. So then if this value is done, if this is true condition, then that value is stored in within underscore 20 underscore percent underscore high. Now we calculate the next filter, that is more than 50% updates in the last 6 months or 126 trading days. Just like we have 1 year as 252 trading days, 6 months is 126 trading days. Now for that, what we do is we'll get the last 6 months data of all the closing prices. Then we calculate the updates. The updates is calculated by 6 underscore month underscore data, which is basically all the close prices since last 126th day till today. And then what we do is we do a percentage change for every day, and we see how many such days are there where the percentage change is greater than 0. The percentage change from one day to the next day is greater than 0. It means it's a positive close. So that's what we are measuring, how many such positive closes are there, and we're doing a summation. This value is stored in up underscore days. Now to get the filtration that more than 50% of the last 6 months are in a positive closing, what I do is I calculate one more metric called up underscore days underscore percentage, which is nothing but up underscore days, the summation of all the positive closing days divided by the length of 6 month data, which is usually 126. So this gives me into multiplied by 100. So this percentage gives me whether how many days are there in the last 6 months where the closing was in green color or in a positive closing. Now we have set or defined all the filtration criteria. Now let's apply the filtration logic one by one. The first filtering criteria that we do is we'll check if the close price, so the DF close minus one being the recent close, is greater than or equal to EMA 100 minus 1, and which in further is greater than or equal to EMA 200 minus 1. This is the first filtration. Once that is done, then and it is not or and, because we need all these conditions to be met, and we say that 1 year return is greater than or equal to 6.5. We have calculated the 1 year return as current day's closing by 1 year back closing minus 1 into 100. So this return of the stock should be greater than 6.5 and within underscore 20% or underscore high. So this condition should also be met, that it should be within the 20% of its 52-week high, and the up days percentage should be greater than 50. Now, once all these conditions are met, then go ahead and calculate the returns of whatever tickers are left for its 6 months, 3 month, 1 month. So for 1 month, it is close minus 21. That is close minus 1 is the current previous day closing. Close minus 21 gives 21 days back, 21 trading days back, or 1 month. Same is the case for 3 days, it is 63. And same is the case for 6 months, it is 126. Now we have the last 1 month, 3 month, 6 month returns. Now to this summary data frame that we have created, we'll append these 4 columns: the ticker, return 6 months, return 3 months, and return 1 month. And if there's any exception, we'll throw out. The exceptions can come in, as you might be seeing in this code when I run. The exceptions will come when the ticker is available, but it doesn't have sufficient data. For example, a stock has been listed recently. So it is there in the index in the Nifty 200 universe, the data is greater than 0. We have sufficient length, some length of that stock, but we do not have enough length to calculate its last 1 month, 3 months, 6 month returns, or maybe sometimes we do not have enough data to calculate its last 100 days, 200 days EMA. Now, in that case, we want to remove those stocks because we do not have sufficient data. So this error catches all those exceptions and throws out. So you will be seeing in this when I run that there are some stocks which do not have sufficient data in the index. Now, once we have all the returns data, the next thing that we want to do is I'll do a simple rounding off so that it is only 1 decimal. And then what I'll do next is I will rank all these returns. I'll rank all these returns in descending format, meaning the stock which has the highest returns is given the first rank, and the stock which is having the least return is given the least rank. Now, once all the ranks for 3 months, 6 months, 1 month are there and are calculated, once we do the sorting and then we give rank rate, then I'll calculate the final rank. The final rank is nothing but the summation of the rank of 6 months, 3 months, and 1 month. If you want, you can tweak a logic a little bit, like maybe you can say that I want to give more weightage to 1 month. Then you can say equal to 0.2 multiplied by this, or maybe you can say 0.7 multiplied by this, and you can give weightage to 3 months as 0.2, and you can give weightage to 6 months as 0.1. So this way you are creating your own custom logic based on whatever is available, so that you can tweak it a little bit based on your choice. If you want to give more weightage to the recent stock movement, or you want to give weightage to more to the oldest stock movement, that you can define and you can create, change this logic a bit. And as I mentioned, you need not take necessarily 1, 3, 6 months also. You can change these numbers here. Instead of, let's say, 3 months, maybe if you want to take 2 months, you can just do minus 42, and that should be it. Now we have taken all the ranks. We have done the final calculation of the final rank. The next step is I want to pick the top 30 stocks. So what I'll do is I'll sort the top 30 stocks by using a function .head30. That will give me the top 30 stocks only. Now after this, what I've done essentially is to create a new column called as position. So the position column will tell me what rank it is at, or what position it is at, because the rank, when you see, is not helpful for us. The rank, when you do a final rank calculation, right, that will give values like 7.55 or 2.33. These are values where we cannot associate with, or we cannot understand clearly. What we need is a clear list of top 15, top 30. So hence I created a new column called as position. So position tells me in what level it is there in the table. So that is based on the length of the of this position of the sticker, and we'll add +1 because in Python the first value of the array always starts with 0. So we add +1 to give the actual position. And then I'll again further break down all these 30 stocks into top 15 and next 15, because I constructed a portfolio of only 15 stocks. So I'm interested in the top 15 and the next 15 also, because sometimes if the 15 stocks are going to the next 15, that is from 1 to 15, if they're going to 15 to 30, I'm still okay. If they are going, I don't have any problem. But if they move away from 30, then I have a problem, and then I exit. So that is, till now, this is the logic of the code. From here on, it is just the formatting and the colors that I use for the data plot. So once you run the code, you will see that for every ticker, it shows the value that the code has been executed. And for some tickers, you see that, for example, Geofinance, which has been listed recently, it says that is out of bounds for access 0 with size 20, but basically doesn't have enough or sufficient data. Same is the case with Tata Technologies, JSW Infra, Adani Solutions. These are all recently listed stocks which do not have enough data. United Spirits is a typical case. It had a symbol called MEC-Dowell. Now it has got changed. So this recent data, it has only of 21 days. So I have to figure out how do we get the past data. Now, barring these 5 stocks, we have data for all the remaining stocks. And this is how the final output will look like. So you have the ticker and you have the returns over the last 6 months. So MassDoc, how to read this? MassDoc has delivered a returns of 101.9% in the last 6 months. And the rank for the last 6 months is 7th rank. So basically, there are some stocks which have returned even more than 101.9. So if you see, there is a stock called RVNL which delivered 134.8, and Oracle Financial delivered 135.5, and hence its rank for the last 6 months is 1. Whereas for Masdoc it is 7. Same way, I calculate the returns and rank for 3 months. Same is the case for 1 month. And then I finally get the final rank. If you see, final rank for Masdoc, which is 11, is nothing but sum of 3, rank 1 month, plus 1 for rank 3 month, plus 7 for rank 6 month. 7 plus 1 plus 3. So that's, say 7 plus 1 plus 3, 11. Yeah. 11 is the rank, final rank. Same is the case with Motherson. We have 5 plus 6 plus 7. So that is 18. So we get a final rank of 18. Now, as I mentioned, these 11, 18, 20 doesn't mean much for us. What we need is the position of this stock in this table. So that is what this position calculates. Till 15 is what I hold in my portfolio, and remaining, if at all they are below that, I'll not add within these stocks. But if at all, once I add these stocks, and when I do a rebalance next time, I do rebalance every 15 days. Once this stock comes up again in this bottom 15 also, I'm fine to hold. Even if it is not in this top 15, even if it is there in 15 to 30, I'm still fine. But if it goes below this, then that's a problem. Then that is when I exit the stock. So this is the code so far. There are a lot of changes or modifications that you guys can do. As I mentioned, you can change the momentum ranks from 1, 3 months, 6 months to different time periods. You can change the filtration criteria of the EMAs. You can change the ranking logic of the summary. Final rank, I used equal weightage of 1, 3, 6 months. You can give some more weightage to different periods and get your stocks. So I'm going to pause here and ask if you have any queries that you have, and I'll go to answer that. So first question I got is from Nimabat. Is it possible to add relative strength comparison with Nifty 200 returns for 63 days? Yes, we can do a relative strength comparison to get even better understanding. So maybe you can use it in the filtration criteria. So in the filtration criteria, what I'm doing last 1 month or last 1 year return to be greater than 6.5%. Maybe you can simply say, take the last 1 year returns of Nifty 200 and see that the stocks or the tickers are beating the last 1 year returns of Nifty 200. So that's a simpler way to pick relative strength stocks in the momentum portfolio. Rahul Gupta asks, what do you recommend for weightage? Is there any backtesting data available? So Rahul, there is no backtesting data as such on the weightages. I'll have to figure that out. I'll let you know once we do backtesting on different weightages. But there is some evidence or some research done on the time frames, that ideally it is best when the time frame is between 3 to 9 months. If it is less than 3 months, it unnecessarily has a counter effect. Whenever their stock rises in the recent past, again it tries to consolidate. A mean reversion happens. Same is the case with the longer term. So there has been academic research study that intermediate momentum is the strongest. That is between 3 to 9. So having too much focus on 1, 3 is also not that good. If you have between 3 to 9, that's good. Okay. Next, there's a question from Ashish. In the initial filter applied to the universe, is there any benefit in having any exclusion criteria like circuit stocks or low liquidity? So there is some. If you ask me, there is some benefit of taking stocks which are more liquid, because it is easy to enter and easy to exit, and that's the only reason. You will protect the downside, because if there's any exit criteria that has been signaled to you, maybe the stock has gone below a certain threshold, or let's say it has gone below 30. If it has gone below 30, then a lot of momentum investors, a lot of other quantitative investors will be dumping that stock. Now, if the dumping is happening and God forbid it reaches a circuit, then the exit becomes painful. Now, if you have to wait for the circuit to end and sell that stock, just because of that stock, it will unnecessarily alter your entire portfolio's drawdown. So this we have seen in certain scenarios. More than the upside, they have a lot of pain in the downside. So that's the reason it is better to exclude all the circuit stocks and low liquidity stocks. There's one more query from Rahul. How long have you followed this strategy? Is it better than momentum-based MFs or strategy indices like Alpha Nifty 50? So Rahul, I'll share the backtested results. So I've been implementing this since April 1st, but we have done a couple of backtests on this data. Specifically with regards to Alpha 50 Nifty, I have to check. I've not compared with that index. And with regards to momentum-based mutual funds. So momentum-based mutual funds, the point here is momentum-based mutual funds have a longer rebalance period of 6 months, whereas in our case, we have a very shorter rebalance of 15 days or 1 month. Now, every user has their own choice or preference, but I personally do not like to hold a stock which has lost momentum for the next 6 months and exit. So that's the reason I have not chosen any momentum-based mutual funds. But let me again do a comparison for this and let you know. How are you considering survivorship bias while doing backtesting? So we have a couple of stocks that or stock-related data in the historical context from 2009 onwards, I believe. So that helps us in ensuring that the survivorship bias is eliminated. So one caveat here is that we take all the Nifty 750 stocks rather than the Nifty 200 or Nifty 50 or Nifty 500. And instead of doing index level backtesting, we do a backtesting at a whole universe level. So even if a stock has moved from Nifty 50 to Nifty Next 50, or if it has moved up from Nifty Next 50 to Nifty 50, within index, there can be a lot of churn. But as an overall 750, the churn might be less. So there are very few stocks that have delisted. So we take that as a reference, and I'll keep you guys posted on how we're approaching backtesting and how we do, and you sure you'll be able to gain more insights on that. Yeah, is the link to your Python script available? Yes, I'll be sharing this link. I did already share, I believe, but because to your email, I'll be sharing this Python code and give you the view access. Yeah, sure, Rahul. Thanks. We will do some backtesting of the strategies and share the results with you. So far, we have been implementing a couple of simple strategies on which can be easily followed on Google Sheets, and to just give a flavor of how backtesting is, because we wanted to do this session for only serious investors who are investing a serious amount of money and want to approach the investing style in a scientific method. So for investors like us, we wanted to build a very strong, small community where we share the best practices, insights, and we build and we grow as a community together. And that's the reason not sharing it on a larger platform on YouTube and on a specific community like this. For fundamental data, so the question that Vikas asks is there any Python library to access fundamental data like OCF or other ratios? So because I'm not aware of, let me check, but there should be some way to get around. I'll see if I can help you in any way. Right now, I do not have any information on the fundamental data. All right. Thanks a lot, guys. Thanks for sparing your time.